What's going on, guys? Welcome back to the channel. In this video here, we're going to be doing a stock analysis on DraftKings. I'm not much of a betting guy. I don't really watch sports to begin with, so this would be a very interesting business to look at. So we're going to look at the fundamentals, the financials, and finally determine a fair price to pay for this business. So we'll load it up in our stock research tool and figure out what this company is all about. Here we have DraftKings loaded up. If you're new to the channel, what I like to do first, folks, is look at our company metrics category, which I'll load up right here. Oop, wrong one. Here, this is the one we're looking at. Look at the company metrics. And what I like to do here, folks, is look at the 5-year average numbers, if they are available, and compare them to the trailing 12-month numbers to try to gauge where this company currently stands and where it's predicted to go. So with DraftKings, it is a brand new company, and I say that loosely because it has IPO'd in the last couple of years, so we won't have that many 5-year numbers on the public market. But we do have some numbers recorded before it went public, so this is from some privatized numbers here. So with our 5-year PE ratio, we actually don't have anything, but we're sitting in the negatives for quite a bit of categories. Our EPS, ROE, and profit margin. Not too great, folks. We want to see some positive numbers here ultimately, because that would mean that they're actually bringing in some, money, right, into the business. And a return on equity, it's not looking too good. It's actually dropped from our 5-year average, so not looking too healthy there either. So here's a key thing, folks, and I typically like to, just forewarning, I like to analyze companies that have been on the market for 5 years, because usually by that point the company has found some sort of rhythm and some flow. So we'll try to see what this business has to offer, even though it hasn't been out for too long. Revenue sitting at $1.3 billion. We have negative net income, negative free cash flow. I mean, we are up over our 5-year average, being at negative 238.6 million in our average, and a trailing 12 months is at negative 51.78. Terrible, but we are up nonetheless. Return on invested capital is also horrendous. Elman Z-score is pretty much non-existent, being at 0.02, and Piotrowski score is sitting at 2. Now, oh god, it's not looking too good, folks. Allman Z-score, we want this to be over 3. Now that would indicate to us that they are safe from going bankrupt. Anything below 1.8 is a concern, and that is a huge concern, sitting at 0.02. Now, granted, it is a new company, so I'm going to give them the benefit of the doubt. Piotrowski score is sitting at 2. We want this number to be between 7 and 9, and 9 is the highest score we could possibly achieve. We don't have that with DraftKings just yet. 2 is a pretty horrendous number. Now, this is an industry, it's a gambling industry, and I see them. I mean, listen, on the odd times that I do watch hockey and stuff like that, like a true, Canadian, and if you're a Leaf fan, drop a like on the video if you like also being disappointed. But if I do decide to watch sports, I sometimes I see like their advertisements here and there. So here's what I know about gambling with sports. It's you either have people that are just die hard in it and they love playing to see, like, to try to call matches and see what the outcome will be. And I know a few of my friends personally, they are huge into sports betting. I don't know. I don't understand it. I don't see the appeal. But I mean, granted, like, sometimes I invest into some shitty companies. I mean, I invested into some shitty companies before, so I guess that is a bet. That is gambling, right? So with this, though, I'm not too thrilled about this business so far. Like, there's nothing that's really impressing me. Let's jump into our next category, which is the financial evaluation, to try to get a higher gauge of where this business stands. And we are ranking this company a 2 out of 10. That is absolutely horrendous, folks. To be honest, I would just not even look at this company any further than that. Now, I know some of you people are probably invested in this business, but I'm just trying to be as objective as possible. 2 out of 10 is a horrendous score. Now, listen, this is a lot to do with it being a new company, and it's not just trying to bash the business from that standpoint. It's just they're not offering me anything just yet that I could say, wow, like, maybe it's worth what it's worth, right? They have to prove themselves. It's a brand new business. So looking at it right now, what they are doing right though, and then we'll go through the positive categories here because we got 2 points here, and that is to the current ratio, which is at 2.96. We want this to be over 1.5, and that's nearly double what we want. That means they have enough assets on hand to cover their liabilities, which is great because with low debt and low liabilities, you're likely to stay on the market, likely to more to do business because, well, if things hit the fan and something terrible happens, you know what? We can cover those liabilities, no problem, and stay afloat. We want companies to have that cushion. Now, our revenue growth is up, and that's the other positive here. So here's the thing: the revenue is going up. It's just that we're not making a profit. Now they are probably, allocating capital to, to either making some acquisitions or putting the free cash flow towards, their debt and stuff like that. So look, revenue's going up. I'm happy about that, but with everything else that's kind of going on, let's investigate that further because there's a lot of things that I'm seeing on this checklist that they're doing wrong. PE ratio, we're not going to even worry about that because it's not a 5-year company, but it'll be a 0. But return on equity, we want this to be over 15%, and ultimately we don't have that. It's sitting in the negatives. EPS growth, we are down. So there's not that much earnings per share based off of currently what we're priced at. Debt to equity is incredibly high, sitting at 77%. Now that means that they're leveraging the growth of the company through debt and not through equity. So they're taking on more debt to grow this business. So that means creditors have a stronger hold on them. We want this number to be under 50%, and we don't have that, folks. So it's just something to keep in mind. This is a silent killer. This thing here is something that people overlook a lot of the time, and I find companies that do well stick below that 50% number, and usually the exceptional companies hover within 20 to 25%. Just keep that in mind, folks. Now, share dilution. Oof. We're sitting at 32% increase over the last 5 years. Now, listen, that is absolutely horrendous. We want companies to either issue, the same amount of shares, keeping the share count the same, or buy back shares, decreasing dilution. When you're diluting your shareholders, you are owning less of the pie. It's like, imagine you have a pizza and everyone just, let's say there's 10 slices. Now someone says, well, we're going to have to cut this up and make it 12 slices. You still have one slice, but now your slice is so much smaller. You get what I'm saying? We want the pizza to have less slices so you can actually own more of the pizza pie. If that makes sense. So 32%, that's a huge jump. And for a company that hasn't been public for that long, that is concerning. But if people are buying this stock price up, and I've said this in other videos too, why not? Why not issue more shares? If people are buying the stock and they're going to cover their debt anyways by just issuing more shares at a potentially overpriced valuation, yeah, of course, they'll just hand it off to you like no problem. Net income growth, we don't have any. Free cash flow growth, we don't have it. Return on invested capital, we don't have it. We want this to be 10% or higher. We don't have that at all. Free cash flow growth and net income growth, well, it's a new business and we don't have any of those numbers. So right off the bat, I'm not too impressed with DraftKings. I would just not even look at this company any further. But listen, you watch these videos to try to figure out what these companies are worth, and I'm going to obviously do that for you, but we'll go into a price analysis to gauge what this business is all about and what should you pay for this business. What is an applicable price? But before we do that, folks, if you're enjoying the video so far, make sure you hit that like button and the subscribe button. You can find it all down here. Now, this software that I have in front of me that I've been showing you so far will be available. It will be an app. If you're interested, send me an email down below. There is my email could be found over there in the description box below. That's invicticamedia@gmail.com. It will be a web app, and you can analyze whatever company you would like. It allows you to look at all the financial data. I just bring you through just the basic section through my videos here, but there's the free cash flow statements, the income statements, the balance sheet statements, all available to you that you can look at, and you can put in your own assumptions, which we'll investigate right now. So here is a price analysis of DraftKings. So we're going to do 3 analysis, folks. We're looking at a 10-year valuation because, you know what, 10 years is not too bad. I think they'll be around, hopefully. You know what? Just for the sake of this video, we'll do 7 because I'm not too sure. I don't know about this business. So we'll go with a 7-year outlook. We're going to do conservative, moderate, and aggressive. And I will populate these boxes. And I'll tell you right now, folks, I'm not liking these numbers that I see here because there's a lot of negative numbers. And when that happens, I have to speculate. So I'll touch base with you in a quick second as I populate all of this. All right, folks, so I've populated these boxes. Before we put our desired return in, I'm going to explain to you why I populated them the way I did. Now, I'm assuming revenue growth of 20, 25, and 30%. Now, you're probably wondering, why am I using such conservative estimates? Because I have to assume the worst and give myself a decent margin of safety. Now, I could go higher. We're looking at 72% and 110% revenue growth over the last little while. Now, like, listen, it's been on the market for 2 years. Like, realistically, they're not going to hit these numbers year over year. It just doesn't make sense, and it's very likely impossible. Very likely impossible. Improbable. So we have to assume a conservative amount of revenue growth. Profit margin. Now here's where things get speculative and things start to unwind. It doesn't make and don't make sense. We haven't had a profit yet. So I have to assume a 10, 15, and 20% profit margin. 20 being this unicorn number. 10 being something that's potentially can happen. It might be even less. I might even just go with an 8% and then 15 on the moderate side. I don't know because we don't actually have those numbers. Same thing with free cash flow. I'm going to go 12, 14, and 20. 20 on the high side. And just speculate it. And price to free cash flow 14, 16, 18. A PE ratio of 12, 14, and 18. 18 being, these are all incredibly low for a 7-year outlook, I gotta say. So I might just do that at 22.5. And PE ratio, maybe I'll just change that to 6. I'll keep the 12 just for giggles because, you know what, if I can get a lower multiple for this, that would make sense. All right, folks, so let's put our desired return in and see what this yields. I'm going to show you. It might show up green, but let's see what that looks like. Okay, so our only rational category right here, being conservative, showing up red, and being at $11 a share to pay for this business. Our current price is $16, and our average calculation comes out to be $33. That means if you were to pay $33 a share for a share, which currently we're obviously under, you'd be able to make that 13% return with this business. Now, the only gripe with that is that none of these numbers actually exist. You are assuming that they're going to hit a profit margin of 15 or 20%, free cash flow margin of 14%, price to free cash flow of 16, and also pretty much all of these numbers just don't exist. So pretty much starting tomorrow, they would have to hit these numbers in order for this number to make sense. Is that likely? Is that likely to happen? Is it likely that DraftKings will start hitting positive free cash flow, positive profit margin, and essentially just a positive PE ratio? Highly improbable. So here's what you have to, this is why you have to have a margin of safety, folks, and this is why I would essentially ignore companies like this until they start making some moves where they're bringing in positive earnings. Now, I know some people will probably say, oh, but they have this going on and that's going on and that. I don't care. I don't care. And I've done videos in the past where if a company's showing me negative numbers, I simply just ignore it. Because, and likewise, you should be doing that too. Because I don't care what they have in the pipeline. They're showing me that they're able to grow 5% a year. That way I can outlook and say, okay, well, in 10 years, given those numbers, if I assume even a 3% revenue growth, assuming they dip from that 5% revenue growth, then I can try to estimate where they might be. This is a fairly new company. They're in the negatives. They don't have any profit. They don't have any free cash flow. I can't assume anything. There's nothing to back it up. Listen, and just to use a sports analogy, And I'll just use a hockey analogy. You have a kid that scores maybe 10 goals in a game, right? Are you going to sign him in a future contract off of one game to say, you know what, this 10-year-old kid, he's going to be the next Wayne Gretzky, Sidney Crosby, Austin Matthews, and say, you know what, yeah, this one game that he's proven, we're going to sign him. It doesn't make sense. He's done one game. He has nothing else to back himself up, and he's just started playing. It could have just been a fluke. Could have been a great game. Terrible goalie, terrible defense, and he was putting goals in the net all the time. It doesn't make sense. So likewise, with companies like this, you need a track record. That's why I say 5 years of being on the market would, at least have some substance that you can work off of. I'll put maybe on a watch list, maybe further down the line. But you know what? Like I'm not a sports guy, and this is somewhat out of my realm of competence. I don't watch sports. I don't really bet. So this is something I wouldn't even care to really own. But this is personal. This is obviously just a personal statement. Listen, you might be a huge sports fan, and this company may make sense to you. However, the numbers that are being expressed here don't make sense to me. And that's it. That's the video. If you liked it, hit the like button, hit the subscribe button. Let me know what you think about DraftKings. And you know what? If you're gonna trade this stock, that's another story. You could definitely do that. It's pretty high volume stock, but as a long-term outlook of investment, doesn't make sense. Doesn't make sense. But remember, folks, do your own due diligence. If you want the software, send me an email. It will be available soon. I'm working on it. I'm working on it diligently because I know some people have been asking for it, and you will receive it. Just trust me. It'll be great, and it'll look way better than what I currently have. Anyways, folks, that's the video. Thank you so much for watching. I will see you in the next one. Until next time.